everything about that trade. What made you enter it?
Got it.
Where you put your stop loss? How you trailed?
The actual game is about this.
How these trades are panning on the charts.
Around the time of India-Pakistan war, our entire market was weak, but this stock, after giving a breakout, was the time when the mid cap was actually coming down.
How do you place your stops?
So again, I just buy. Most of the trades don't work out well. So I don't enter into all these 20-30 stocks because.
Based on your experience, is there any advice or two that you want to give them?
So I feel.
दोस्तों, आप में से बहुत से लोग स्विंग ट्रेडिंग करते होंगे, चाहे वो प्राइस एक्शन बेस्ड हो या इंडिकेटर बेस्ड। लेकिन हमारे जो आज के गेस्ट हैं ना, वो आपको एक बिल्कुल डिफरेंट अप्रोच बताएंगे, जिसको यूज करके आप मोमेंटम स्टॉक्स को फिल्टर कर सकते हो और उन्हें ट्रेड कर सकते हो। हमारे आज के गेस्ट हैं साकेत, जो कि एक बहुत पॉपुलर फेस हैं। साकेत पहले भी आ चुके हैं शो पे, जहां उन्होंने ऑप्शंस ट्रेडिंग के बारे में बात करी थी। लेकिन इस बारी साकेत एक बिल्कुल डिफरेंट अप्रोच बताने वाले हैं, और स्पेसिफिकली स्विंग ट्रेडिंग के बारे में। और साकेत हमें यह भी दिखाएंगे कि इस अप्रोच को यूज करके फ्यूचर्स को कैसे ट्रेड करना है। तो चलो बात करते हैं साकेत से और सीखते हैं कुछ नया। Saketh, welcome to Trading Ki Baat again. So good to have you back on the show, man.
Thank you so much, Arjun. It's a pleasure to have a chat with you again.
Saketh, the last time we talked, I think we talked about options trading.
Right.
And in the recent past, a lot of people have been having issues with options trading. The markets have been volatile. There have been a lot of regulatory changes. Knowing you shifted a lot of your capital.
Right.
From options trading to swing trading.
Right.
Now, first of all, I would want to ask you, what was the issue that you were facing with options?
Right. So if you take a look at my journey, Arjun, right? So from the year maybe, let's skip the prior to 2020 where there was leverage. From 21 to 23, so my returns on options was close to around 30 plus CAGR, right? So on 23-24 year, I ended up with 12% CAGR, 12% growth, right? So this is when I realized, so I was spending a lot of time and effort by trading options where I'm sitting from 9:15 to 3:30 and I'm doing everything. So the spikes were coming, one spike used to take away the entire day's gain. So then I saw that the return, what I'm getting on the efforts that I'm putting, is actually not worth it. So if I were to end my year with 12% or 13%, it's not really worth it by putting all my money into, let's say, Nifty Bs, Gilt Bs, where I do 50-50, and my portfolio is earning 10%, I am earning somewhere around 10-12%. So net, I am making somewhere around 20-25% itself. So that's when I thought, okay, if there is a way where I can try to focus on equity, where I can take my equity returns to somewhere around 20-22%, and my option returns where I can simply automate it and try to aim for around 10%. So net again, I'll be going back to around 30% with much lesser efforts. So the return on the efforts that I would be putting in will be maximized if I just change my focus a little bit. So that was the key moment for me to shift mostly to swing from options.
So Saketh, one thing which I would comment is that he was able to pivot.
Right.
And pivoting is hard for people because they keep staying with the same strategy.
Right.
If it's not even working, they continue putting money in that strategy. Right. So good you pivoted. Now we've had talks with a lot of swing traders. They've come on the show and they've discussed their methodology.
Right.
Now Saketh, is it something similar that you do when it comes to swing trading? Like, is it typical price action or indicator based, or is it something different that you do?
So you can say in a way it's both. So the price action concepts in a way remain the same, but how I pick my stocks is slightly different. And I do use an indicator. I will be just sharing a framework with you. So I use multiple things, but this is like a pretty solid framework which a lot of people can use. And that is based on RSI, but I will assure you that it is nothing similar to what you read in your books or nothing similar to what you would have come across other videos.
Okay. Yeah. And Saketh, the swing trading that you do, is it limited to indices or you do it in stocks specifically?
Right. So I mostly do it only on stocks because in the stocks is where you can easily identify momentum. So when the days when the markets are not doing well and your stock hits an all-time high, new 52-week high, so you know that the relative strength in the stock is higher. So I usually target such stocks only.
So Saketh, you've said that this methodology that you have is not to be found in any of the books.
Right.
So let's directly jump to the topic and understand from you.
Sure.
how you use this method to pick stocks.
Absolutely. So Arjun, what I'll be sharing now is again not something which came overnight or something, right? So I don't like obviously trade alone. So I do have a team. So this is something which the team has actually sat for well over quite a bit. I would say maybe somewhere around 12 to 14
Okay.
months, and we have tried a lot of things. But this we felt was a very simple framework. So this is not the only thing we use, but this is a pretty good framework to start off if you're doing momentum, right? So it starts with a simple RSI, right? So generally, when you go out there in any particular video or any particular book, so you might have heard saying that okay, 70 RSI is overbought, 80 RSI is overbought. It's good to short over there, right? And anything around 20, 30 is oversold, and it's good to
Right.
go long over there. Right, so but a lot of people today don't really understand how an RSI really works. So a lot of us here just see what is overbought, oversold without really understanding what or how exactly RSI works. So I'll just start with that by explaining what exactly RSI is, right? So then they will also get an idea on where exactly we are headed
Right.
into. So let's just compute a simple 5-period RSI. So I'll just tell you how to do the same.
Okay.
So let's take a stock X, right? So let's say on day 1, the stock went up by 1%, right? On day 2, the stock fell by 0.2%. On day 3, the stock again went up by 2%. Day 4, the stock came down by, let's say, 0.6%. And day 5, the stock went up by, let's say, 0.5%, right? So broadly, when you take a look at this, all right, so let's try to compute a 5-period RSI, right? So the RSI computation starts with something known as RS, right? So that is relative strength. So this relative strength value is nothing but your average gains divided by average loss. So if you're putting a 14-period RSI, they'll calculate for the last 14 periods. If you're putting for a 5-period, it will
So
calculate
it
for
will
the
take all the gains and all the losses and
and
do
it
an
will average,
average time.
right? So here our average gain is 1 plus 2 plus 0.5, so that is around
3.5.
3.5 divided by 3. So that will come to around 1.2, let's little
Right.
less than
1.2.
1.2.
Yeah.
I'll just keep it as 1.2, right? And our average loss is around 0.4.
Correct. So 0.8 divided by 2.
0.8 divided by 2, right? So the value comes to around 3.
Right.
Right. So now how RSI is actually calculated is nothing but 100 divided by, 100 minus 100 divided by the RS factor, which is 1 plus the RS factor, which is 1 plus 3. So that is 100 minus 100 by 4,
100
which
by
is
4, 25.
25. So RSI value comes to around 75.
Okay.
Right. So this typically is seen as a overbought zone.
Right.
But anybody who is like when you just look at the numbers, like leave the RSI part away, leave the indicator away, just look at this particular chart. So if you're seeing the way the stock is performing, you know that every gain is much higher than its average losses. So the stock is finding support, or you can say that every time it wants to go down, there is a good buying pressure which is holding the stock. And whenever it is going up, it is actually moving much higher.
Correct.
So these are the kind of stocks you actually want when you're doing a momentum trade, right? So it is exactly opposite of what people say. So you want to enter into stocks which are at 70 RSI, 75 RSI, because that indirectly shows that the relative strength on the stock is much higher than overall, right? So if the average gain and average loss is equal, or let's say somewhat similar, you're going to get 50, which means there is no no relative strength or no relative weakness, right? So the first thing starts by picking a stock which is actually showing some strength on the RSI one. And what we are going to do is maybe try to enter into stocks which are actually hitting an RSI of 70 or 75. So then second one, if you want to simplify the framework, so where do you actually get out of the stock, or where do you take your exits, right? So you can simply take the exits whenever the RSI of the stock starts to come below 60. So that means the average losses have started to increase compared to the average gain, and you can simply start to take your exits whenever the momentum starts to fizzle out. So this would work mostly well on a monthly chart or a weekly chart because it will avoid a lot of noise what gives on a daily or a shorter time frame chart. So what I would do is I have already done a simple Pine script code. I will just run it through the Nifty 500 stock list, where we will be entering the stock whenever the monthly RSI of a 14 period crosses 70, and we'll be cutting the stock whenever it falls
So
below
Saketh,
60.
just to understand, this method that you have, this is like a trend identification kind of a system,
Right,
where you are using RSI
right,
to identify
right,
which stocks or which instruments are currently trending,
right,
and you're using monthly or weekly RSI for
right,
that.
right.
Okay.
So this is again what happens is when you take a list of 500 stocks, so very likely you'll be getting 30, 40 plus stocks where the relative strength is stronger or relative strength is high, right? But when you are actually wanting to enter a stock, it's not that you can enter into all 30 or 40. So we'll come to the point of where how we decide what to pick and what to choose amongst the stocks.
So Saketh, you mentioned that you have a Pine script, or
Right.
basically an indicator,
Right.
which tells you which stocks are trending and all of that.
Right.
So can we see how it looks like?
Sure. So what I have opened here right on the screen is basically the Pine script strategy tester. Right. So here you see that 65-55 strategy report, but it's actually RSI. I have changed in the Pine script to 70-60. But the thing here, what you have to note is, Arjun, it doesn't really matter what value you put. It's about the end of the day, if the core of the strategy is good, so you make it 55, 65, 70, 60, whatever it is, it should be overall good. Right. So now we are running this on a simple monthly time frame, right? And this is basically the total number of trades the let's say the signal would have been generated on from the time of listing. So what you would mostly observe is we are just going to run through the Nifty 500 list, and you can see the kind of returns it would have given on a, let's say, a good trending stock, and the kind of loss it would have made on a stock which doesn't work, right? So this is maybe one trade what we have got, and that one trade is a profitable trade where it has so this is another stock where it has returned somewhere around 694%, right? So this stock has not given any trade, so it has not satisfied the condition of coming into the trend. So this is another stock where it has returned somewhere close to around 2800%.
And how long is this backtesting period?
So from the time of listing.
Okay.
So what you realize here is you can see how the trades really work. So only 2 out of 7 trades are profitable, which means the probability is just under 30%. But where really, or what really makes the difference is the profit factor.
And Saketh, this is on futures or equity?
This is equity only.
Equity
only.
Okay.
Right? So the real difference in the trend following comes not with the probability, but it comes with the profit factor, where your risk to reward is going to be at least 3 or 4 times. Right? So this you can just run it through most of it. So again, this is another stock where there is hardly any returns made. But what you observe is wherever the stock has actually trended. So you can see that totally we have had 3 trades. This is over a period of say 20 years or 15 years. So what we also get to understand is that we don't keep getting all these stocks so often to enter. Maybe out of 500 stocks this year, you might hardly find 20 or 30 stocks, right? So next year you might find 20 or 30 stocks. So that is how usually it works. So generally in a bull market, you find most of the stocks coming all in together. And whenever the market doesn't trend, you hardly find handful of stocks satisfying the condition.
Correct.
So that is how it works. So you can just maybe run through or scroll through the entire list of Nifty 500 stocks, and you find the results to be really good. So this was one of the this thing for us. Okay, maybe we can try something on the RSI, right? So this was like a you can say an important point when what we were testing out with momentum strategies, that we can use this as a maybe a parameter that whenever we are doing momentum, we can add this and take a look at it. So you can see the time over here. It has given 3 entries from 1999 to 2025. So it doesn't often come. So whenever it comes, it generally comes with a good risk to reward.
Trades are less in number,
Very
but they are
low
effective.
in number. Yeah, very effective. And once they come, you do have a higher probability. Probability is not high, but you have a significant risk to reward where you can actually take a bet on the trade, right? So now the question comes, right? So even if 20-30 stocks are coming, right? So it is not possible to create a portfolio out of all 20-30 stocks. So because things will be coming, things will be going. You have to keep circulating, allocating the funds, remove the funds from one place, put it into another place. So even though it looks simple, right? So creating a portfolio out of it is not so straightforward, right? So here is where we use some kind of discretion also when it comes to what kind of stocks that we should be choosing, right? So that is where the discretionary bit of it comes. Now, you've given two stocks. Let's say there's a X stock and a Y stock. So which stock are we going to choose?
So Saketh, this concept that you have,
Right.
can we see some examples how these trades are panning on the charts?
Right, absolutely, Arjun. So here I have just opened a chart of a stock, right? So let me just show you three charts maybe,
Okay.
so you can tell which two you would pick, right? So this is one chart. Maybe I'll show it on a weekly time frame. I'll show it on a monthly time frame. All right. So this is one stock where the RSI is again close to or above 70 on a
70,
weekly. Even
right.
on a monthly chart, it is above 70. Right.
Okay.
So it's around 74 and all. Right. So this is one chart. And this is another chart of the similar kind where the stock RSI is again above 70 and the stock has seen a massive run up. So now let's start with these two itself. So given that today if I have to make an entry, right? So which chart would I pick, right? So the answer to that is quite simple. The one which is coming out of a consolidation, which offers me a better risk to reward. So I can have a tighter stop loss. It offers me a better risk to reward. So there is no harm in entering this, but here the only issue with entering such stocks which have already seen a massive run up is where do you actually put your stop loss or where do you actually come out. So sometimes even though like let's say a simple idea of exiting below RSI 60 is good, but the problem what happens is maybe something like Polycab or S Bank. So there were times when you have also already got entries in these stocks, and if any news based result comes, right, so the one single candle is going to wipe out 20-30%.
Right.
And so while you can also keep that as a good stop loss, but you should also have a better risk management in place. So you can't really wait for the month close and the RSI to form. So this is one chart, and the other one is this. So maybe right now, if you were to enter, it looks quite extended or gone up. Maybe if you were looking at the same thing in a slightly smaller time frame, I would say, right? So
Looks better.
looks better. So maybe somewhere these would be a good entry point with a relatively lesser stop loss, right? So why exactly? So first of all, would it work? The answer is we don't know, right? So your probability is not very high, but your risk to reward would be generally very higher. So entering these stocks, maybe with this as a stop loss, right? So maybe somewhere over, this is a weekly chart. So this should be a good swing low as a stop loss.
Okay, so you're using somewhere below the base.
Below the base, right? So again, this is discretionary, right? So you're just filtering out certain set of stocks based on a criteria, and then you're applying some amount of discretion to it to see what is going to be good, right? So here again, so this would be a pretty good trade because you can expect a higher risk to reward because the stock is just hitting a fresh all-time high. It is looking strong in the momentum perspective. So if the stock were to run up, so you can easily expect 1:3, 1:4 risk to reward. So these are the kinds of trades which I usually scan. So I will share one of the trades which I had taken earlier in the month of April, right? So which is almost around 4-5 months back. So this was in both BEL as well as BSE.
Okay. So Saketh, what I want to understand from you is how you took an entry, where you placed your stop loss, how you trailed, or your exit point, and your overall risk management.
Got it. So this was one of the trades which I had taken around 3-4 months back when this breakout really came. Right, so this was the time when the market was heading lower, and this was also, I think, around the time of India-Pakistan war.
So what time frame is this? What chart time frame are you using?
The chart time frame I'm using here, I have just put weekly.
Weekly.
Yeah, but you can use it on monthly, daily. So below daily, I don't definitely recommend. So why I would maybe use a daily is because rather than waiting till the month end to make the entry, maybe if you get a good entry on a week, you can take a look at it. So now this was a strong candle close, and the RSI of the stock at this point was again above 70. So it made a perfect case for entering, and the stock also had momentum, right? So I got into it, and what I do after getting into it is basically whenever I buy futures, I only do in F&O stocks. So I don't enter into Nifty 50 stock, sorry, Nifty 500 stocks as it is.
Okay.
Right? So I only do it through F&O.
You do it for the leverage.
Yeah, I do it for the leverage because I want to ride momentum with leverage, right? So whenever I'm doing this, the first thing I do to manage my risk is just buy a 10% away put. So irrespective of whatever it is.
Okay.
So just buy a 10% away put. And next what I do as the market starts to go up, right? Or as my stock starts to go up. So here, as and when the price goes up, my puts are going to become cheaper and cheaper. So it is easier for me to shift further, right? So like the puts come down, the price of the puts come down, and I can easily shift up by paying a fractional cost.
You roll your puts up.
Yes.
Let's say you started at 1,000
Yes.
and you bought your put at 900.
900.
Stock starts moving 900, 950,
Yeah,
1,000.
right.
Okay.
So I start rolling my put up at one point. So I would totally be risk free. And this we are looking on a weekly chart. But maybe if you look at it on a daily chart, maybe somewhere like over here. So these are the points where if the position is good, or position is like, let's say the stock is already trending. If the position is good, I don't mind adding some additional quantity at these points also, because my first trade is anyways risk free. Right, so I would have entered somewhere over here. Now my hedge will be way above my purchase price, so I leave the trade as it is. So I don't consider it as part of my existing trade. So I look at this entire thing as a new trade altogether.
So fresh breakouts you trade entirely as a different
trade. So even though that I'll be adding into the same stock, but if I find some good conviction on the stock, so I do add up. So when do I get conviction? So again, here it's mostly on a gut feeling, right? So where I feel the stock is doing well, it is giving me an opportunity to add on. So how do I get this gut feeling? Mostly I look at the markets. Let's say I am trading a mid cap stock, how the index is performing and how this stock is performing relatively. The days when, let's assume this is a mid cap stock, and on the day mid cap index is going down, let's say over a period of last 3, 4, 5 days, the index is going down, but my stock is holding strong. Right? So these are the kinds of triggers I look for to add on to my position. And later, whenever the market is trying to recover, the stock gives a fresh breakout. So that is a perfect candidate for me to add on some.
So Saketh, in this example, let's say you enter at this fresh breakout. How do you place your stops?
So again, I just buy around 7-10% puts.
Okay, there's no hard stop loss that you have.
Right.
It's only a put.
So what I would do is, so my hard stop loss, my view would get invalidated below this because I am seeing the consolidation going on for
and would
many
you wait
days.
For a daily candle close below this
Yes,
level?
Yes.
Candle close.
So because I am not really concerned about the fall because one set of my trade is already in profit, right? And that is also going to end in profit. So this is just a new trade which I'm taking. And if the fall actually comes, so in the worst case, I have a put. If not, I can, if not things work out well, it is going to go away. So then again, here I add a bit of discretion. So whenever I see a huge run up happening and I would have certain targets in mind. So let's say I would be aiming for 10%, 20%, 30%. So I see that, okay, the stock has given that target or most of the target within a very short span of time. I also start doing collars. So I already will have a put. I will just start selling a call above because it would have already hit my target in a very short time.
So you'll take out some of the cost of that put.
Yes.
And maybe earn some more on that short call.
Right. So in such cases, what I do is very aggressively bring up my puts and short a call to cover the cost, because now it has come to say 70%, 80% of my target, which I already had in mind. So I'm more than happy to ride if it is going up. But if it falls, I will be very well protected.
Okay.
So again, what viewers should note is most of the trades don't work out well. All right. So that is a very important thing to have in mind. So half of them usually lead to false breakouts. But whenever they lead to a false breakout also, It's about how much you are giving back to the market and how much are you taking when things
Right,
work in your
right.
favor. Especially when you're doing with futures, so you will be by default levered by 4 to 5 times, right? So any move of say 20%, if I end up entering entirely my account, so full size of my account, any move of 20% can double your capital, any move 20% down can wipe out your
Correct,
capital,
correct.
right? So it's slowly you step into the trade, as and when the market gives you more cushion, you can slowly build onto the position. So that's usually what I
So
do.
Saketh, just to
Yeah.
recap, what you're doing is you're taking either monthly,
Hmm.
weekly, or your daily time frame.
Right.
And like even for a daily time
Hmm.
frame,
Hmm.
are you like double checking with a higher time frame whether the RSI is more than, let's say, 70 or not, and taking a trade there, or do you look at time frames independently?
So first, how I would like to put this, Arjun, is the very first thing is the RSI filter, where I see that strong momentum is there.
Okay.
So then I don't keep revisiting it back again and again, because if it's at 70 till the month close, it will remain at 70.
Yeah.
It is not going to come down,
Correct.
right? So I don't keep revisiting it. So now I have list of stocks. Let's say I have list of say 15-20 stocks, and I have to pick a stock from this 15-20 list. So how am I going to do that? Scan it manually, see which is offering better risk to reward, see which is offering maybe a better breakout. The structure of the breakout is stronger, it has consolidated for a while and coming out of a breakout.
And Saket, you take stocks
Uh,
only after breakout, or you take them before breakout as well?
no, I generally take it after breakout,
Okay.
and I keep the SL below it. So now weekly and daily is something where I used to let's say enter the stock at the breakout, and to add the position again I will be mostly using daily charts, where I see track the market performance, relative performance of the
So
stock.
Saket, what I understand
Hmm.
in a nutshell
Hmm.
is that you take a higher time frame,
Hmm.
you find stocks which are already trending,
Right,
which have been in an uptrend,
right,
and then you look for fresh entries on a smaller time
right,
frame like daily or
right,
weekly,
right.
and you trade breakouts on that smaller time
Right,
frame.
right. So another example which I would like to show. So in all these 20-30 stocks, you will see uh, entire my entirety of profit would have come from just 4 or 5 trades, right? So or maybe more than 20-30 stocks, I would say. So most of it will just end in no profit, no loss. Some will end in loss. Others will end in small
You need
profits.
to ride your winners.
Right. So most of it would have come from just the outliers of 3 or 4 trades, and that would have gotten in all.
Saket, in order to better understand and like get into your mind, what I want is to understand from you, as an example, one of your trades, uh, everything about that trade.
Got it.
What made you enter it?
Got it.
Where you put your stop loss? How you trailed? If you added
Mhm.
size to that,
Got it.
what made you add size? So that we all get a better idea
Got it.
how you are trading this entire concept.
Sure. So this is a recent trade which I had taken, Arjun. Right. So again, you might see here it gave a pretty strong relative momentum, because even if you see the red candle here, maybe historically the green candles are much higher.
So RSI is above 60,
RSI
70.
is above 60-70,
Okay.
and the relative strength is also higher,
Mhm.
right? So now this has given a pretty okayish like relative strength. So now there are a list of stocks which again I usually scan, and this stock I see is coming out of a multi-year breakout, and the stock is also showing some strength. And this was also the first time the company posted a positive quarter-on-quarter result. So they were increasing the sales, cutting down the expenses
Okay.
drastically, right? So then again, I go back to slightly smaller time frames
Weekly.
just to take a look at it, and this looked like a fairly good trigger for me. This looked like a fairly good trigger for me.
Because it
Huh.
is breaking out.
Breaking out, and on the other time frames on monthly also, the stock is showing some momentum, and I thought the risk to reward on this trade should be good, considering that okay, it is coming out of almost 2.5 years of consolidation. So obviously my low of this candle would be my SL. So I had bought the puts at 900 initially to start off with, so 900, 950, and then again to make my entries or take further entries, so I would want to go on to a smaller time frame, and that generally would be a daily time frame.
Okay.
What you see here is during this period where the stock was actually consolidating, was the time when the mid cap was actually coming down, right? So every day there was a continuous sell-off which was happening, and the entire index was falling. The even Nifty was falling for that matter, right? So this was the same period where entire market was weak, but this stock, after giving a breakout, was holding strong. And the first sign of reversal, so this stock again gave a good breakout. And this was again a second trigger for me to add on to my positions, because here is where I added some massive quantity.
Okay,
And
so you took your starting trade
Hmm.
on weekly,
Yeah,
and then you added size on this daily
daily,
breakout.
yeah. So now it had given me some good conviction to bring up my puts and also add some
So
massive
Saketh,
sell.
if we go back to weekly,
Uh-huh.
I just want to understand your
Hmm.
exact entry point
Hmm.
and how you placed your stop.
Got it. So this was the weekly breakout chart
Uh,
which I took, this candle.
okay, you
Huh.
took the trade here. Fine.
I took the trade here when it was around 1050, 1060.
Mhm.
So that was the entry point, right? So the low of this was the SL.
The weekly bars
Huh.
low.
So also the thing what you have to note here is while I took this trade, right? So this was while this actually gave a weekly breakout. So that was the time when the market was again further coming down. It was not that the like market was
Yeah,
supporting or
yeah.
going up. So this was again a better. This was able to help me build more confidence on the trade, because the market is going down, but this stock is able
So
to,
relatively stronger,
yeah,
this stock is.
relatively much
Yeah.
stronger. So this on a daily chart would look even better, because it's. I think we already saw how it looked on a daily chart, right? So this was one of the entry triggers where I took. Again, this trade will work out or sometimes might not. So I would say 80% of the breakouts which happen something similar to this will fail, like won't work out, because this you might have seen earlier also, it won't work out, right? So a small position which I entered, my puts were at I think 950 or 900, right? So my exit was this, below, if it is by any chance closing below that, I would be exiting the
Okay.
whole trade. So that was the entry trigger for me. And then it was about, okay, the things started to go well. So where exactly can I add some more positions onto my trade? So again, for that, I came back to daily. And this is where, again, as I told you,
You
I
added.
entered back into the trade. Right over here, I added some more quantity where I saw that it had given a pretty fairly good breakout whenever the market was trying to bounce back.
And Saketh, I
Hmm.
want to understand
Hmm.
one thing. Like the original trade that you
Hmm.
have,
Hmm.
um, would you trail the stop loss in that?
Yeah, so I wouldn't be trailing. I'll just be bringing my puts closer in.
Closer.
Huh.
Okay, just move the puts. That's
Yeah,
all.
yeah, just move
So
the puts.
there, how do you like book out profits? Where will you book your trades?
Right. So here is where I will tell you what exactly happened. So I would tell you, like, if the view gets validated, what would have happened? If the view gets invalidated, what would have
Okay.
happened? Right. So here the view actually got validated by the market, and the stocks, I added some massive quantity. The stock started to go up. So now I will tell you where I booked out the profits. All right. So there was some positive news based trigger here, and the stock made a high. So then after that, what happened? The stock consolidated for again 2-3 days and further gave a breakout. Now this was more than sufficient for me to roll over all my puts from 950, 900 to almost around 1100.
Okay.
So it was more or less like my one set of trade is absolutely risk free. The other set of trade is now at break even. So any further roll in the puts will make my trade completely risk free, right? So that is what actually continued to happen. The next day the stock went up, the other day the stock went up, and by this time, something like 1200 puts had become so cheap because we were approaching almost the end of expiry. There were hardly any days left. And I was able to roll up my puts to almost around 1220 or 1200 just by paying few pennies. So making my entire trade absolutely risk free,
Okay.
right? So now the hedging cost was very low. And that's the reason I was able to bring. And on the expiry day, I got my puts to 1260, which is like right at the money, and I shorted some calls to make it a cover, like collar.
Okay.
All right. So now how it would have worked if not the case. Yeah, right. So if the hedging was not cheap, how exactly it would have worked? So then in this case, let's say I have added a quantity here. So as soon as it got invalidated, so I would have cut the extra quantity what I have bought, and I would have just held on to my existing quantity. So if the stock again further continues to consolidate, right? So then I will hold on to my initial futures which I have bought, right? Only if it gets invalidated, I'll completely
Okay.
come out of it. So the thing is, the actual game is about this extra quantity which actually gives you the leverage to make bigger returns. So just by your initial quantity, you won't be making much of it, right? So only when you add your extra quantity, where you almost, let's say you're entering example 10,000 quantity, you make it into 25,000 or 30,000. So that extra trigger is what gives you the comfort to ride it. So why exactly I add extra here is because now my one part of the trade is already risk free. So I'm only risking the second part of my trade with a much lesser stop loss. So much lesser time to exit. So that is the second idea how exactly I work. And these kinds of moves are something which I don't really prefer. So something that goes too fast. So that's where I start to bring up my puts very
So,
aggressive.
Saketh, let's say, like this keeps going on.
Mhm.
Would you book your profit somewhere? Do you have some kind of targets, or is your exit strategy only puts?
So actually, I do work with some targets. So like initially when I was, okay, let me just show you how exactly I look at it. So this is a classic case of momentum. So any momentum trader you would have got on the podcast would have told you this very simple idea or a logic, right? So that is basically what everybody does is they go on a monthly time frame, weekly time frame. So they see what is the swing low of the previous this thing,
Okay.
right? So let's say it's around 33-34%. So they just put the same thing on the top, right? So that is basically from this particular trigger, if the stock has fallen 34-35%, so then they put the same thing on the stop, which is 34-35%.
So means whatever was the swing high to swing low
Yes,
percentage,
yes.
that is your target.
Yeah, that is usually, that's how the momentum concept works. So whatever is the previous swing low, that usually gets put on the top and they consider it as a target. But there is a time for it to achieve. So if everything goes in a straight line, it's not something really healthy. So you want it to slowly move upwards towards the target with some good consolidation, right? So that is actually eventually your target, right? But if you see that the stock has already run up quite a lot or going towards your target much before you anticipate, so then I would like to book most of it because I see that it has achieved most of it before I anticipate.
So if the move is too sharp, and let's say in technical terms, it has stretched too far from the mean, as in it's gone too far too soon, then you'll book out some. Otherwise, if the move is a little slow, then you'll let it continue.
Right. So I'll show you another example where I rode a stock. So again, I made some significant gains from the stock, but I didn't book out. But I waited for my put to become active, and then I totally got it. So this is another example, Arjun. Again, this was during the India-Pakistan war, where we got a good breakout from a stock. Right. So you can see it on a much lower time frame also. So again, here the first trigger was your RSI showing 70 plus. So this was on a weekly time frame a good trigger to enter, right? So the stop loss was a weekly close or a daily good strong daily close below this. So when you enter this, you initially start by putting some lower hedge, say 5-7% lower hedge, right? So then the reason why you are doing this is because you are okay to give that some cost because you are already levered. So you don't want, so if the stock is going say 5-6% in your favor, you are actually making 20-25%, right? So you don't really have to worry about that small gain what you will be giving with the hedge. So now a strong breakout on a weekly chart, good entry trigger. Even on the weekly and monthly, the RSI was above 70, which is indicating momentum, right? So then again, you go back to daily. We look for further entry triggers if there are any, right? So the initial entry has happened somewhere over here. So this would be somewhere around the initial entry. So I ride it, then the stock consolidates. So this is a breakout again, which I will be entering into, right? So because my first leg of the trade is already profitable, I have added brought my puts above my buying price, so there is no need to worry about the first leg of the trade. Now if I see this independently, strong breakout on the weekly chart, strong breakout on the monthly chart, perfect candidate for adding positions. So I add positions here, right? And again, this is a very massive run up, which generally I don't prefer a lot, but it gave. But here is where, like what I did is, from this point I got my puts all the way to 16,000, right? So maybe I could have trailed it little more further, little more aggressively when the stock came in here, but I didn't do that. So then finally, after that, the very next month, you can see it saw like non-stop fall, like continuously non-stop, right? So here is where my put not just expired in the money. I think I had bought the put at somewhere close to around 160, 170 rupees, and it expired at 1,700.
So it completely hedged the fall.
Yeah, it
like
completely.
after a point, after
Right,
this point,
after this
it
point.
hedged the fall.
So I did give up my gains significantly, almost around 1,400, 1,500 points. But from the point of entry, it was still fairly
That's the thing with trend following. You can never catch the bottom,
Right.
and you can never catch the top.
Right.
Only you eat this part
Right,
of the move.
right.
Yeah. Now, Saketh, one very important thing I want to cover, and that is you are doing futures, which is a levered product. Okay. Now, how do you maintain your position sizing when you're doing futures?
Got it. So this is a very simple answer to this, Arjun. So it is first starts with at how much exposure you have towards the market at any point in time. So generally, to be honest, I am okay if like, because I am making good amount of money when things go well. So it's very high what I do. Generally, I expose around 25% of my capital in a worst case event. Let's say if I'm hedging 10% lower, and if the market actually comes and hits at my initial this thing itself, so I might wipe out, let's say, 20 to 25% of the capital.
So your max drawdown theoretically is 20% to 25%.
Yeah, yes. Okay. If the view gets completely invalidated and next day there is a news-based trigger, it completely comes down. So very likely I'll be wiping that out, right? So, but the thing is, one more thing what you should also note is I don't compound my capital very aggressively, right? So if I am able to make 20-25% in 2-3 trades, right? So then I'm okay for a one black swan to happen where I wipe out 20, because I'm not compounding the capital. So very likely more than 50% of what I make, because I know that I am getting into something very risky, I pay out, right? So I don't keep it back into this thing, and I don't invest in the same account where I.
So Saketh, you are an aggressive trader,
Right.
and that is why you've made such returns.
Right.
But for somebody who is a little more conservative and wants to follow similar approach, what do you think? How should he size his positions?
Right.
How much of a drawdown should be there realistically?
Right. So realistically, when you see, you might get maybe when you start, this is not the right position size to go, right? So you can go with such a in a way where you can have a max loss of say 8-10%. Slowly build your cushion, then you increase your position, because your so today if I'm going for 25%, because I have some gains made up, so I'm ready to give it up, right? So if nothing is made or nothing has been done till now, so then it's better to build up a cushion such that you maybe max lose out on say 7-10% in the worst case, where you will also be having a hedge, right? So if things go well in your favor, so let's say the stock gives 13, 14, 15% move, you'll be very well again making somewhere close to around 13 to 15.
And Saketh, how many positions do you have at any given point of time?
So generally, like how I do it, Arjun, is like it's very again discretionary based. Sometimes I enter into the stocks, but if I feel that something is rewarding me more, I don't mind cutting down some of the positions and shifting into that. Wherever I feel that okay, the stock is actually moving, it is rewarding me, I want to have most of my money there. So that's how I generally look at it.
Understood. And Saketh, let's say you get signals in about 10 stocks. Okay. Now, how do you pick which stocks to go for?
Right. Again, the entire framework what I showed. So let's say the filter today might again show up 30-40 stocks, right? So in this 30-40 stocks, obviously, even though there are futures for, let's assume there are futures for this 20-30 stocks. So I don't enter into all these 20-30 stocks, because the first thing what I see is So if there is any stock which I have already followed in the past, that would be my first preference rather than entering into a new name, because I don't know what kind of volatility the stock would be seeing or how exactly it would be behaving. That is the first one. Second one, what kind of breakout the stock is actually giving, that we already
Let's
discussed.
say you have a similar kind of a breakout or a formation in 5 to 10 stocks.
Okay.
Do you put positions in all of those or you select some?
So generally that doesn't happen. Like very rare cases you find that happening. But if I do find, I would first be going with the names which I have already followed.
Okay.
Right. So if there is a new name coming into the list where I have not followed the stock or how exactly it has done. So sometimes I create watch list and I keep following the names. So anything that comes to the list in the beginning itself, my first preference is to go for them, because I would have seen how usually when it is coming down, how it falls, when it is going up, how it goes up.
Saketh, I think it's a very interesting overall approach that you have. And one of the key things two things actually that I've taken away is that, go for RSI on a higher time frame and pick out stocks. So let's say out of 500 stocks, maybe you'll have 30, 40 that are trending properly.
Right.
And then find entries on a smaller time frame.
Right.
And that too, you have puts in your trade so that you can roll them up and you can set kind of a stop loss with those puts. Now, Saketh, like if somebody wants to start trading using this similar approach, based on your experience, is there any advice or two that you want to give them?
So I feel instead of going for a stock in particular, what you can initially start off is maybe the index itself. Right. So maybe we can just see the same RSI on an index, and whenever you get let's say a proper trigger, rather than going with futures and all of it, maybe you can go with a simple ITM call option and take a look at it. So you can deploy very low amount of capital, so you can maybe put your foot into the trade, experience how it is going, because it's as good as buying an ITM call is as good as buying a future and a put, right? So the reason why I do it, because when I'm putting in most, I don't have to put in cash margin. I can put it as a margin when I'm doing with futures. But if you want to initially start off, you can simply go with the ITM call, because you will have exposure under control. So you will be knowing in the worst case how much you will be losing, the amount that you will be giving upfront. So there you can actually decide how much you want to get into. Maybe start with a simple index. So whenever the index is having a good RSI, maybe index hitting 70 RSI, 75 RSI is very difficult. So maybe you can look for something lower, something like let's say 65, 60, and you see that the positive momentum is there, and then look for a smaller time frame just to see that if you can get a good entry. Then try small with a ITM call option. That should.
Saketh, you gave us your time. You explained so much, and you've shared a lot of information. I'm sure it's going to be helpful. It's given me a couple of ideas. Thank you so much for your time.
Yeah,
it's been wonderful talking to you.
Yeah, likewise.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.